to the virtual CPE seminar on filing of returns of individuals and tax planning for salaried employees. May I request the Vice Chairman of ERNAKULAM branch of SIRC of ICAI, CA KV Jose, to kindly welcome the guests and the speaker. Over to you, Jose.
Thank you, Deepa. Good afternoon, everyone. Our speaker for this afternoon, CA Isidore Lukose, our MC colleagues, Secretary Deepa, immediate past President Roy sir, and past immediate past Chairman Roy sir, and past Chairman Srini, and other Salim also there, other senior members and friends. A warm good afternoon to all of you. We know we are in this month of September 2021. As everyone knows, September month is a very busy month for chartered accountants. So many reasons. One main reason is filing of income tax returns. Most probably the last date for filing income tax returns ends in the 30th September. And also signing balance sheets, issuing audit reports. We are very busy during September month. But this year it may be very busy month for all of us, because we all know that the IT e-filing portal is in a big mess, as everyone is bad experience for the last June, July, August 3 months. We are facing a lot of issues in filing returns. And what I understand that there are many mails received in the Ministry of Finance from various stakeholders, including our Institute of Chartered Accountants of India, regarding around 2,000 issues were there. Around 2,000 issues, and if it taking collectively around 90 unique issues or problems faced by various stakeholders in the e-portal. And now I think the forms are getting filed. Form number 1, 2, 3, all are getting filed. But sometimes still there are issues. There are some delay in getting the acknowledgement. There are sometimes OTP is not coming. And then new regime, if you opt for OTP, validation is not happening. And sometimes we cannot view the returns. These all are the issues. Still it's going on. And maybe most probably by 15th of September, this may be all solved. That is the information we get from the income tax department as well as through the media. So this month, friends, we managing committee of ERNAKULAM branch has decided we are going for many programs on direct taxation. We will have the refresher course, and we are planning webinar on international taxation, then some direct chain seminars on direct taxation. So definitely we will have more programs this month. And today, we have a very eminent speaker, very eminent faculty, our own member, CA Isidore Lukose. I know him for the past few years. He is one of the faculty members in our institute for our coaching classes, and very dynamic, very vibrant CA Isidore. He will be explaining on various aspects of filing of returns of individuals and tax planning for salaried employees today. With wholeheartedly, I welcome Isidore, our speaker for this day, to this online seminar.
Thank you.
I also welcome all the managing committee members here. Welcome all of you. And I also welcome all the participants, including our senior members and friends, to this CP seminar. So thank you. I am sure we will have a wonderful learning time, including today in this month. Thank you very much. Over to Deepa.
Thank you, Joseph. It's my pleasure to introduce the speaker for the day. A youngster with 5 years of post-qualification experience. He is a founder of Isidore Lukose and Company Chartered Accountants. He's a non-executive director of Redefines FinServe Innovatives Private Limited, one of the emerging business advisory provider in Kerala. He's worked as assistant manager finance and accounts in Vodafone in the Idea Limited. He's also a faculty member of ICAI Kochi branch for CA Inter Taxation, and he's a faculty at various other institutes for CA, CMA, and CS intermediate and final level. He's been a regular speaker for seminars conducted by ICAI and other organizations and on audit and taxation. And in addition, he is an excellent sports person. So with these words, may I welcome CA Isidore Lukose for his delivery of the topic today. Over to you, Isidore.
Thank you, madam, for your kind words, and thank you, Josar, for your introduction. So I will share the presentation. Hope it's in full screen mode. Okay, so thank you. So good evening, all the members.
If I may interrupt you for a second, please. For the participants, if somebody wants to see the presentation, please keep your browser on the PPT and you will have an icon to expand the PPT. So you can see it in bigger version. Thank you. Over to you, sir.
Okay, thank you, ma'am. So good evening all. I know almost everybody who is attending this presentation will be very much senior to me, and I may be very too young for taking a classes, but still, so I would like to give my little knowledge or the latest updates on the new income tax portal. And as Josar pointed out, say September month, the due date of filing returns for individual non-tax audit assessees is on 30th September, which was earlier July 31st, and now it has been extended due to COVID pandemic to 30th September. And as Sir said, say the new income tax portal, actually there are some issues going on, and probably almost everybody are expecting an extension in the due date, but still as of now 30th September is the due date. So since it is a very peak time for the filing of returns, so I would like to give a view on the new website. Then for the salaried employees or those who are filing ITR 1, what are the key areas, or they should be familiar with the new website. So all those things, and the provisions of salary, house property, then chapter 6A deductions and other tax planning areas. So where to invest, say in order to get the maximum tax benefit. So all those things are what we are going to discuss in this session. So the points for discussion will be the due date of filing returns, what are the different ITRs which are applicable to each assessees. Then in addition to ITRs, certain forms has to be filed before filing the return. So what are the additional forms which are applicable for each assessees? Then we were using the old income tax website for a long year, and a sudden change from the new website to the old website to the new website, actually the interface has been changed. So many clients, those who are already filing by themselves, has already called me and said the new website actually it is looking so different. Where are all the functions? Say they are not able to identify, say how to e-verify or how to view the 26AS. So we will see where in the website is all these keys mentioned. Then we will see the new tax regime versus old tax regime. 115 BAC has been introduced. So what are the concepts, or what are the ways in which how to opt for the 115 BAC, the new scheme? Then we will discuss the provisions of salary, house property, chapter 6A deductions, and the way in which we have to file the return. And soon after filing the return, earlier we used to take a printout and send it to CPC Bangalore, but e-verification is also possible nowadays. So what are the ways in which e-verification is possible? So these are the topics which we are going to discuss today. Now the due dates, there was notification just 2-3 months before due to COVID pandemic. So the due date, which was originally say on 31st July or 30th September, they have been extended say by 1 or 2 months. So we will see what are the latest due dates as on today. Say sometimes on the coming days there may be an extension, but still as of now these are the latest due dates for filing of returns. Say income tax return for the assessees who are not subject to audit, say like our normal individual salaried employees or small businessmen who are not liable for tax audit. The due date is, the original due date was 31st July, and right now it is extended to 30th September. So today is September 3rd, and this month end is the due date for filing returns of individuals or non-tax audit assessees. And income tax return of assessees who are subject to audit, okay, those who are liable for tax audit, the original due date of filing return was 31st October. Ideally, earlier it was 30th September and it was extended to 31st October. But the due date of filing the tax audit report, say 3CA or 3CB plus 3CD, so it is 1 month prior to the date of filing return, that is 30th September. And the due date of filing return was 31st October. And right now the due date of filing return has been extended to 30th November. So 1 month extension is given. So as of now, so we will be very busy with the non-tax audit assessees, and within 2 months we will be soon closing the tax audit assessees. Then income tax return of assessees who are subject to transfer pricing. So the transfer pricing assessees, it was 30th November earlier, and now it is extended by 1 more month, that is 31st December 2021. And the tax audit report, as I said earlier, the tax audit report has to be filed 1 month prior to the date of filing return, and it was 30th September. Now it has been extended to 31st October. So the tax audit report has to be filed by 31st October, say 3CA or 3CB, and the ITR has to be filed by 30th November. The transfer pricing report, say transfer pricing report has to be filed by 30th October, again 1 month prior to 30th November, and right now it has been extended to 30th November. So the transfer pricing report, audit report in 3CE has to be 3CB has to be filed by 30th November, and the ITR has to be filed by 31st December. Now the revised return or belated return, say earlier from the last year, actually it was 1 year, it was 31st March, and it has been due to the digital processing, it has been reduced by 3 months. It was actually 31st December, the due date for filing revised return or belated return, and it has been extended by 1 month, and now the latest due date for filing belated returns, which means the return which has to be filed, which we can file even when we do not file within the due date, or the revised return if there is any error or omission. So it is, the due date is 31st January 2022. So as of now, our latest, the very emerging, the due date is 30th September, which is the due date of filing returns of assessees who are not subject to tax audit. And there is, from the circular which announces the extension for due date of filing return, there is a clarification which is given related to 234A. So section 234A talks about the interest if we file the return beyond the due date of filing return. The extension of due date for filing income tax return shall not affect the interest for default in furnishing ITR if the amount of balance tax payable exceeds rupees 1 lakh. Ideally, if we do not file the return within the due date, then interest under 234A attract on the balance tax payable. So if it is a refund, then 234A will not attract, but if it is a tax payable, 234A will attract. So even though the due date has been extended, still 234A interest will attract if our tax payable is 1 lakh or above. If it is more than 1 lakh, if it is less than 1 lakh, then 234A interest will attract only if it is filed after 30th September, or else if the balance tax payable is more than 1 lakh, then 234A will attract even if we file within 30th September, but after 31st July. now we will see, so we have seen the due dates. Now we will see the different ITRs. So there was some delay in announcing or in declaring the ITRs, but right now all the ITRs has been notified. All the forms are actually available in the new income tax portal. So the new latest ITRs are ITR 1, or we call it as Sahaj. ITR 1 is applicable to the individuals who is resident and ordinarily residents. So those who are non-residents, so they cannot use ITR 1. ITR 1 is applicable for only resident and ordinary resident having total income up to 50 lakhs from the following sources of income: salary, one house property, income from other source, and agricultural income up to 5,000 rupees. So a salaried individual or a person having one income from house property or income from other source. So the normal salaried employees who are having say house property loss or say few FD interest, so they can use ITR 1, which is which can be filed online as well as in offline mode. ITR 1 cannot be used by a person who is a director in a company who has held any unlisted equity shares at any time during the previous year, who has any asset including financial interest in any entity located outside India, has signing authority in any account located outside India, has income from any source outside India, is a person in whose case tax has been deducted under section 194N. 194N is a TDS which is applicable on cash withdrawals exceeding 20 lakh or 1 crore. Then who is a person in whose case payment or deduction of tax has been deferred on ESOP. Say ESOP, the point of taxation on ESOPs has been extended to 4 years in a newly startup company. Then who has any brought forward loss or loss to be carried forward under any head of income. So if anybody has loss to be carried forward, then they cannot use ITR 1. So a simple salaried employee who is having salary income and say some interest IFOS and maybe one house property loss or something, then such persons can use ITR 1. Then ITR 2. ITR 2 is applicable to individuals and HUF who are not having PGBP income and who are not eligible for filing ITR 1. ITR 1. So he can be either resident or non-resident. So general normal non-residents who are having say certain small incomes and who are not having PGBP income, they can use ITR 2 to file their returns. Say one non-resident, he is having just interest incomes, then they can use ITR 2 for filing their returns. Then ITR 3 is used by an individual and HUF who is having income under the head PGBP. So if any resident or a non-resident, say if they have PGBP income, so suppose if they view their 26AS and they could see certain professional receipts or certain business incomes, business receipts, and if they are not showing it under IFOS, then ITR 3 has to be used because they have PGBP income. So even if a salaried employee who is having certain other business incomes, then they have to use ITR 3. Then ITR 4 is to be used by an individual, HUF and firms other than LLP. Individual HUF who is a resident and ordinarily resident, or a resident partnership firm who is having income up to 50 lakhs or having income from business and profession which is computed on presumptive basis under 44 AD, ADA, AE, and income from salary, house property, agricultural incomes up to 5,000 or IFOS, they can use ITR 4. So suppose if a person, if an individual HUF or resident partnership firm, if they have presumptive incomes, then they can use ITR 4 for filing their returns. Now these are the ITR 1, 2, 3, 4 are the forms which are applicable for individuals. Okay, individual HUF, say ITR 4 is applicable for resident partnership firms also. So generally in this particular month we will be filing say ITR 1, 2, 3. And say since if we use presumptive scheme, then tax audit is not applicable for them. If the person is opting 44 AD or ADA, they are not liable for tax audit. Then they have to file the return within 30th September. So 1, 2, 3, 4 has to be filed within 30th September. Now, apart from ITRs, there are certain income tax forms which we have to consider while filing the returns, or which has to be uploaded in the income tax side before filing the ITRs. So we will see what are the different forms, say, which we will be coming across say by say, probably there are possibilities that the clients will be asking us what is this forms, or say they will be bringing up with these forms to us, or these forms are relevant, or these forms has to be collected or to be verified in order to file the ITRs. So what are these forms? Say form 12BB. Say form 12BB is provided by employee to employer, containing the evidences or particulars of HRA, leave travel concession, deduction of interest on housing loan, deductions on tax saving investments, etc. So in order to get form 16 from the employer, say that employee has to submit the details of his investment. Say in a year, say the maybe twice or thrice, the employer will be asking for investment declarations. Say what are the various tax saving investments which we have. So this details is being collected by employer in order to arrive at the figure at which they have to deduct TDS on salary. We know that the responsibility for ensuring that the deductions are accurate, say the responsibility is casted on the employer by the department. So the employer has to collect the documents which are related to the investments, verify it and approve it, and deduct the remaining tax liability as TDS. So the employer will ask the employee to submit the tax saving investments, then the interest on housing loan or other tax deductible claims which he have. So the employee has to submit it in form 12BB. Now second one is form 16. Form 16, we are coming across it for all the years. So form 16 is the certificate of TDS deducted on salary provided by employer to employee at the end of the financial year, containing the income, deductions, exemptions, TDS for computing the tax payable or refundable. So basically, what is the structure of our total income? So what is the gross salary, or what is the loss from house property? Then what is our gross total income? What are the Chapter 6A deductions? What is our net total income? What is the tax liability, and how much tax has been deducted as TDS, and what is the balance tax payable? So the summary of all these fields will be given by employer to employee in form 16. So many a times when we file the returns of individuals, we will be cross verifying the form 16 and the 26AS, and we will be filing the income tax returns. So form 16 is the document given by the employer to employee, which contains the details of TDS on salary. Then form 16A. Form 16A is the certificate of TDS deducted on income other than salary provided by deductor to deductee issued quarterly basis. Say there may be cases, say in case of business income, say 194C or 194I or 194J, say certain TDS might be deducted. So in such cases, the deductor will issue a certificate in form 16A containing the details of income, TDS deducted and TDS remitted to the assessee on a quarterly basis. And if, say, suppose I am not having any salary income, or apart from salary income, if I have any other incomes, say, or say TDS on FD interest, or say business incomes, then on the TDS deducted, so they will be, the person who has deducted will be issuing us form 16A. Then form 67. Form 67 is the statement of income from a country or specified territory outside India and foreign tax credit to be submitted by taxpayer on or before the due date of filing ITR. Say Form 67 is to be filed by the assessee in the income tax portal. So what is Form 67? It is generally filed by a person who is having income from outside India. Say certain IT employees, IT company employees who are having say certain on-site work in say outside India, say US or UAE or some other countries. So they might be receiving certain incomes from their employer outside, and for which there will be tax treaty with India, and they might have paid tax outside India, and as per section 90 or 91, unilateral bilateral relief or unilateral relief will be eligible. So in order to claim the tax credit, in order to claim the credit of tax paid in a country other than India, they have to file Form 67 before filing the ITRs. On or before the due date, they have to file Form 16. So those persons, they have to file Form 67 plus they have to file the income tax returns. Then Form 26AS, it is the annual information statement provided by Income Tax Department available on the Traces portal containing the details of TDS, TCS, advance tax, self-assessment tax, specified financial transactions, demand or refund, pending or completed assessment proceedings. So Form 26AS will not be sent to us. We have to download it from the Traces portal. It will be available. It is a report generated from the Income Tax Systems Department and which is available for all the taxpayers. So we can compare the Form 16 with the 26AS, whether the TDS credit is matching as the TDS as per Form 16 is matching with 26AS, and there are a lot of issues which comes, or the normal individuals who file returns by themselves, say they will come with a 143.1 notice, and the major issue in 143.1 is say 26, all the incomes in 26AS has not been shown in the ITR, and when we go through the 26AS, we will see that only salary incomes will be fetched in Form 16. So the employer will be considering only the salary income for deducting the TDS, and they will deduct TDS in the actual amount. But they will have certain FD interest or some income from other source on which TDS at the rate of say 10% might have been deducted, but say their slab rate might be 20% or 30%, and thereby they will have additional tax payable. So they will not disclose those income in the ITR because they are not aware of it, because they have not watched the 26AS. So if we ignore the 26AS, there is a very high possibility that the income from other source or certain FD incomes might have been omitted, and there is a possibility that in 143.1, say the difference, the total income as computed by the department and the total income as declared by the assessee will be different, and a tax demand will be arrived at. So we have to be very careful to cross check the 26AS and Form 16. Maybe in 26AS additional incomes will be available. Then Form 15G. Form 15G is a declaration by a resident taxpayer claiming receipts without a deduction of tax submitted by a resident individual less than 60 years or HUF or other person other than company or firm to bank for not deducting TDS on interest income if the income is below basic exemption limit. Say Form 15G, generally if we do not have income above basic exemption limit, then, and if say we have only certain fixed deposits and we are receiving interest on these fixed deposits. So if the interest on fixed deposit is more than say 40,000, they will be deducting TDS under 194A at the rate of 10%. So due to COVID in last year, it was actually 7.5%. All the TDS rates were reduced by 25%, 25% of actual. So they might have deducted that they will be prone to deducting TDS, but in such cases, the resident assessee, the resident individual or HVA for other than company and firm, so they can submit form 15G declaring that their total income is below basic exemption limit and hence they will have zero tax payable. In such cases, the bank managers or the bank officials, they can collect this 15G and they can credit this interest income without deducting TDS. So there is a high possibility that, say, we will be arguing that even if our income is above basic exemption limit, since due to 87A rebate of 12,500, even if our income is above 2.5 lakhs but below 5 lakhs, there is a high possibility that our tax liability is zero. So in such cases, if our income is above basic exemption limit, actually form 15G is not allowed. So 15G for resident individuals less than 60 years, if only if the income is below basic exemption limit, the 15G is valid, or else 15G is actually invalid. But in case of form 15H, 15H is a declaration filed by a resident individual more than 60 years claiming receipts without TDS deduction for not deducting TDS on interest on income. Actually 15H is submitted declaring that our tax liability is zero. So tax liability is zero, which means that, say, even if our total income is above basic exemption limit but less than 5 lakhs, and due to 87A rebate, if our tax liability is nil, then 15H is accepted. But whereas 15G, if income is exceeding basic exemption limit, even if our tax liability is nil, 15G might not be accepted. Then form 10E. Form 10E is a form which is filed for furnishing particulars of income for claiming relief under section 89 when salary is paid in arrears or advance provided by employee to income tax department. So those who are claiming relief under section 89, say many of the central government or state government employees, so they will have regular pay revision, say once in 2 years or once in 3-4 years. And the last year, say certain central government employees had 15 years, say, pay revision. So in such cases, they will receive huge arrear, and we know that arrears are taxed in the year of receipt. Generally, salary is taxed on due basis or receipt basis, whichever is earlier. But arrears are actually, say, since we will be able to know the figure only on actual receipt, it is taxed on receipt basis, but we will be able to claim relief under section 89. In order to claim the relief under section 89, we have to calculate the tax liability with arrears, without arrears for all those years, and we have to submit form 10A. But form 10A need not be signed by chartered accountant. It is a self-declared form and it can be filed by the client, by the assessee itself. So form 10E has to be filed, uploaded in the income tax portal, and only after filing this form, we have to submit our ITR. Then next, form 10BA. Form 10BA is a form declaration to be submitted by assessee who is claiming deduction under 80GG about the rent paid on residence containing the details of the name of landlord, address, and the amount submitted, and the amount which is submitted to the department. So suppose for salaried employees, if they are staying in a rented premises, there are two options for them. If they have HRA in their salary package, they can claim HRA exemption, house rent allowance, as per section 1013A. But if they do not have HRA, if they are not in receipt of HRA during the year, then they can claim chapter 6A deduction under section 80GG. 80GG is deduction allowed for the rent paid. So in order to claim deduction under 80GG, we have to file form 10BA. Say form 10BA contains the details of the landlord to whom the rent is paid and what is the monthly rental and what is the address of the landlord. Those details has to be filed in Form 10BA only, and it has to be e-verified using the other OTP or any of the e-verification method. And only after filing Form 10BA, we have to file the income tax returns. Actually, today I tried to file a Form 10BA, but the OTP is showing as invalid OTP. So as of now, I am trying it for the last 2 days, but maybe say due to the new website has some issues. Maybe I feel it is because of that the Form 10BA I am not able to file as of today. Maybe within next 2-3 days it will be corrected, I hope. So these are the latest forms which we have to file along with the ITRs. So ITR 1, 2, 3, 4, any of the ITRs will be filed, and along with that, say these forms, whichever is relevant, is to be filed before filing the ITRs. Now we know that the new income tax website, say it was earlier incometaxindia efiling.gov. Now it has been changed to incometax.gov.in, and the interface has been entirely changed. Earlier we have to upload XML file for filing the returns, and right now so it has been JSON file for filing the returns, and the interface has been say much similar to the GST website. The interface has been changed, and when we log in to the income tax portal, say we could see this e-filing site, and there is dashboard, e-file, authorized partners, services, pending actions, grievances, etc. In grievance column, say if there is any issues which we face, we can submit the grievance for that. And if we wanted to file the income tax return, then we have to go to the e-file, and if you click the e-file, there is income tax returns, income tax forms, etc. And from the income tax returns, say we can file income tax return. We have to click the file income tax return, and there are other various options like view file returns. Say earlier when the site was launched, actually we were not able to see the previous filed returns, but right now the data has been transferred. Now we can see the earlier filed returns from assessment year 2013-14 onwards. Sorry, 2014-15 onwards. All the ITRs which we have filed is visible in the new website. So we have to click on the file income tax return to go further. And when we click the file income tax return, say this is the latest dashboard available, and we have to select the assessment year, and assessment year 21-22 is available right now. And there are two modes of filing. So one is online mode, and another one is offline mode. Say in offline mode, either we can use the offline utility, or we can use third-party softwares also. And for individuals, say we can use, and they are recommending online mode also. So if there are only say a few salary amounts or certain, if they have Form 16 and 26A readily available with them, they can easily use this online mode for filing the returns. And our new income tax portal, say the income tax filing has been divided in 3 stages. Actually, there are 3 stages of filing return as per the new dashboard. Say first one is validate return, second one is confirm your return summary, and third one is verify and submit. So first point is validate return. So it is actually say yes or no questionnaire which is given in the portal. So we have to select yes, or whether if any deductions are available applicable for us, we have to select all those are yes and others as no, and we have to go ahead. All the stages we have to confirm. Okay, say they will show confirmed. So after confirming all those 5 steps, then we will be able to go to the return summary and then verify and submit. So validate return, in the validate return stage, actually there are further 5 stages. First one is we have to give the personal informations. Then we have to compute the gross total income. Then we have to declare our deductions under chapter 6A. Then we have to declare the taxes paid details, say TDS or self-assessment tax details. Then they will automatically compute the total tax liability, and we have to ensure that our tax liability matches with the say form 16 or our calculations. And then if we proceed ahead, then we will see the total amount of refund or balance tax payable as per our computation. So the personal information contains our name, address, Aadhaar number, bank account details, etc. Then say system automatically captures details from our form 16 as well as 26AS also. And if we edit the amount, the system will show the amount mismatches with the form 16 or 26AS, but still we will be able to save it without any issues. Now, what are the prerequisites for filing ITR? So suppose we wanted to file ITR, then what details should be available with us? One, registered user on the e-filing portal with valid user ID and password. Say we have to register ourselves in the income tax portal with using our PAN number. Our user ID will be always PAN number, and we have to generate a password. Say if we are filing it for the first time, we have to sign up. We have to give our primary email ID, secondary email ID, primary mobile number, address, PIN code, etc. And the status of our PAN should be active. Now we have to link the PAN with the Aadhaar. So Aadhaar has to be quoted while applying for PAN and while filing of returns. So we have to link our PAN with Aadhaar. Then we have to pre-validate at least one bank account number and nominate it for the refund. So our bank account should be pre-validated. So there are certain issues when people try to validate their bank account. If the mobile number registered in the bank is different, or the name is different, or the PAN is not mentioned, then there is a high possibility that it will not get validated. In such cases, say we have to contact the bank also. So we have to validate the bank account, and we have to select this bank account as the account to which the refund has to be credited. Then valid mobile number linked with the Aadhaar, e-filing portal, bank account, NSDL or CDSL. So we have to have a valid mobile number which is registered in the bank. Say our bank account should be linked with this mobile. Then the Aadhaar number should be linked, not linked, it should be registered. Then only Aadhaar OTP will be coming to our mobile number. Linking and registering is actually different. Then we have to download the offline utility or avail a third-party software. So earlier, as I said, either we can file using online mode or we can use offline utility. The utility is available in the income tax portal, or we can use say third-party softwares like Winman, etc. Now, almost all the salaried employees, so they will have confusion on whether they have to choose say old regime or new regime. And many of the employees who are working in companies, so they have called us saying they have received a mail, and in the mail they are asking, the company is asking them to select or to opt new scheme or old scheme, and they have to give a confirmation so that the TDS will be deducted according to the scheme which they selected. So the employees, they do not know what is the difference between new scheme as well as old regime, new regime as well as old regime, new regime under section 115 BAC. So there is a point in tax planning or that tax consulting in which we can explain them the differences between 115 BAC and new old tax regime and which one is beneficial for them. So that is actually tax planning and it is not a tax evasion. So what is the tax rate in the existing tax regime and new tax regime under section 115 BAC? So in the existing regime, the basic exemption limit is 2,50,000 and 2.5 lakhs to 5 lakhs, 5%, 5 lakhs to 10 lakhs, 20%, and 10 lakh above it is 30%. So if we have a tax liability, if we have a total income of 10 lakh, our tax liability will be 1,12,500 and income above 10 lakhs will be taxed at 30%. However, as per the new regime, that is 115 BAC, the basic exemption limit remains the same, that is 2,50,000. But very interesting fact which we have to understand is, say for senior citizens as well as citizens above 80 years, super senior citizens, still their basic exemption limit is 2,50,000 as per the new regime. But whereas in old regime it is say 2,50,000, 3 lakh and 5 lakhs. Say for resident as well as non-resident, say the slab rate remains the same in the new regime. Now, as per the new regime, up to 2.5 lakhs, tax rate is nil. 2.5 lakhs to 5 lakhs, it is 5%. 5 lakhs to 7.5 lakhs, it is 10%. 7.5 to 10 lakh, it is 15%. 10 lakhs to 12.5 lakhs, it is 20%. 12 lakhs, 12.5 to 15 lakh, it is 25%. And more than 15 lakh, it is 30%. Say if a person is opting 115 BAC, up to 10 lakh, his tax liability will be 75,000. And if his if his total income is exceeding 15 lakh or is 15 lakh, then his tax liability will be 1,87,500. And over and above 15 lakhs, it is taxed at 30%. But say a blank explanation on this slab rate will lead to misinterpretations, because generally if a person is, if an assessee is opting 115 BAC, he has to forgo many exemptions or many deductions. So only by not availing all those exemptions and deductions, then only he will be able to select 115 BAC. But very interesting fact is that a person who is not having PGBP income, say he can choose 115 BAC or the old regime, and he can change from new to old and old to new any number of times. Say if while declaring investment to the employer, even if I opted old regime, still while filing the return, if I feels that the new tax regime is beneficial for me, then I can select the new tax regime, and vice versa also. And in each year, I can shift from old regime to new regime or vice versa. But when this slab rate and the other general points is the surcharge and cess are the same under new tax and old tax regime. Say surcharge above 50 lakhs for individuals, HUF, AOP, BOI, say more than 50 lakhs, surcharge will start. And 87A rebate. 87A rebate is for resident individuals whose total income is not exceeding 5 lakhs. Then they will be eligible for rebate 100% of the tax or 12,500, whichever is lower. And this rebate is available under both regimes. So generally, if an employee whose net total income is below 5 lakhs and who is having only salary income or IFOS, then even if they select net total income 4,50,000, then they can comfortably select the old regime because their tax liability will be nil. But if we select 115 BAC, there is a possibility that the net total income for the purpose of 115 BAC may be more than 5 lakhs and they will be liable for payment of tax. So if our normal tax liability or the net total income as per old regime is not exceeding 5 lakh, then comfortably they can choose the old regime and they need not select the old regime. Now, if we wanted to select 115 BAC, then what are the exemptions or deductions which we have to forego? And these exemptions are generally be claimed by salaried employees on a huge amount. Say, leave travel concessions. Generally, the employees in corporate companies, they have leave travel concessions, which the amount has been deducted from their salary and rest of the salary is being credited to their account. And leave travel concessions are the clay concessions which is given for traveling, and if they on a leave, if they went for some travel, then they can submit their bills and they can claim this amount as a refund, and it will be given to them from their leave travel concession amount, and it is tax free. If they are not availing it, then the amount will be given to them, give as salary, and TDS will be deducted. So this is actually a tax free income or reimbursement for employees, and we have to forego this exemption. Then 1013A, house rent allowance. So if we see the salary structure of almost all the employees, most of around 90% of the employees will have this house rent allowance in their salary structure. So the salary structure is structured in such a way that, say, whatever exemptions are there in the income tax, so those exemptions can be claimed by the employees. So generally section 1013A HRA allowance is there. HRA house rent allowance is for paying rent on rented premises. And as I said earlier, if a person is not on receipt of HRA and still he is paying rent, then he can claim 80 GG deduction under Chapter 6A. And in order to claim 115 BAC, we have to forego section 1013A HRA exemption. Then 1014 allowances. So section 1014 deals with the allowances, special allowances, which are for which there are exemptions, and those allowances we have to forego. Then 1017, 10 clause 17 is allowances for MP or MLA, which generally very few cases will be coming to us. The allowances for MP and MLA we have to forego. Then clause 32 deals with income of minor child from in case of if the minor child is having income which is to be clubbed with the guardian, then 100% of the income or 1,500 whichever is lower can be claimed as exemption. Such exemption we have to forego if we are claiming 115 BAC. Then 10 AA is related to cess, it is related to PGVP income, and recently, say from 2020 onwards, say 10 AA fresh deductions are not available, but those who have already claiming it can continue claiming it. Then section 16 deductions, so that is a very important point, because most of the salaried employees say they straight away calculate their income as, say, gross salary less 50,000. So they may not be knowing what is the point of this reducing 50,000, but they are being taught as, say, 50,000 will be allowed as deduction. Very interestingly, if we are claiming 115 BAC, then standard deduction, section 16 deductions, standard deduction or entertainment allowances deduction, then professional tax deduction, these deductions will not be eligible. Then clause B of section 24. Clause B of section 24. Section 24 deals with income from house property, and 24B talks about self-occupied house property. We know that the self-occupied house property, the NAV is nil, and we can claim deduction on the interest on borrowings, interest on borrowed capital for construction, acquisition or repair of the self-occupied house property. And obviously there will be a loss in income from house property, and the loss can be set off against income from salary. But if we are opting 115 BAC, then we cannot claim say claim this interest borrowed capital, and the loss from house property cannot be set off against the income from salary. So generally, if a salaried employee who is having housing loan and there are certain interest expenses which is being claimed as loss from house property, then they have to compare 115 BAC or old tax regime, which will be beneficial for them. Then other deductions or other clauses deals with PGVP income, say additional depreciations, then 32 AD, 33 AB, ABA, 35 2AA, 35 AD, 35 CCC, all those deals with business expenditures, say site restoration fund, then scientific research, and specified businesses, etc. So those points are related to business, and these deductions has to be foregone. Then in case of income from other source, under section 57, family pension expenses. Say if we go through the ITR, we can see that against income from other source, the only deduction permitted to be typed in the ITR is the deduction relating to family pension, say which is say 15,000 or 1/3 of the pension, whichever is lower, and this deduction has to be foregone if we are opting 115 BAC. And very interestingly, deduction under any of the provisions of Chapter 6A other than 80 CCD2 and 80 JJAA, other than these two sections, all the Chapter 6A deductions has to be foregone. Say generally the senior employees, say with more than say 35 years or 40 years, obviously they will be claiming 1.5 under 80C. But I could see that the youngsters who are into the employment, say their 80C is not 1.5, say they have huge gap up in the 80C deductions, say only 25,000 or 30,000 or 50,000 are the amounts which they are claiming under 80C. But when we see a say 40-year-old salaried employee or 50-year-old salaried employee, obviously their deductions under Chapter 6 under 80C is say 2 lakhs or 2.5 lakhs, and it is limited to 1.5 lakhs. So the tax savings schemes opted by the youngsters nowadays are the tax planning strategies are not exactly operational. So there are huge opportunities or for the youngsters for tax saving. So investment. So the spending nature, since the spending nature of youngsters increase, the tax savings under tax savings schemes are getting reduced. So Chapter 6A deductions like ATC, ATCCC or ATCCD, ATD medical expenditures, then any Chapter 6A deductions other than ATCCD2 which is available say for NPS contribution, and 80 JJAA which is for tax audit assessees, say for additional employee cost, but which is not relevant for salaried employees. So these, except these two deductions, all other Chapter 6 deductions has to be foregone. So we cannot straight away blindly say that 115 BAC, since that there are increased slab rates, and if up to 10 lakhs it is 75,000 and not 1,12,500, we cannot blatantly say that 115 BAC is the best scheme. We have to compare it. We have to calculate the tax liability without these exemptions, and we have to see the enhanced gross total income, and we have to see the tax liability, and which one has lower tax liability, we have to choose that option. And there is a dialog box in the new ITR whether assessee is opting 115 BAC, and we have to click yes or no, and we have to go ahead. Then surcharge and cess. So surcharge and cess in the new tax regime as well as old tax regime is same. So surcharge is a charge or the tax which is levied on super rich persons, and the tax liability or the surcharge is calculated on the basic tax. Surcharge is calculated on the basic tax, and it is levied depending upon our total income. Say if our total income is exceeding 50 lakh and it is up to 1 crore, then our surcharge is 10%. If it is between 1 crore and 2 crore, the surcharge is 15%. If it is more than 2 crore up to 5 crore, the surcharge is 25%. And if it is more than 5 crore, then the surcharge is 37%. So actually, the highest surcharges is for individuals or individual HUF, AOP, BOI at the rate of 37%, whereas for corporates, the maximum surcharge is only 12%. Okay, if it is exceeding 10 crore. If it is more than 1 crore, 7%, and if it is exceeding 10 crore, only 12%. So employees, the salaried employees who is showing normal, say income from salaries, then and if they are having say high salaries, then the maximum marginal rate is increased to 42.744%. That is the highest tax rate applicable. But 111A, 112A, and 115 AD, the maximum surcharges is 15%. Say 111A and 112A deals with short-term capital gain and long-term capital gain on listed equity shares and units of equity-oriented fund and units of business trust, etc. So on those incomes, the maximum tax liability, the maximum surcharge is limited to 15%. Health and education cess is 4%. That is, say, flat 4% for everybody. And this 4% cess is charged on basic tax plus surcharge. On the amount of basic tax plus surcharge, cess is calculated. Health and education cess at the rate 4%. Now, so when we file the income tax return, after filing the income tax return, say verification is possible. Say, as I said earlier we used to take the printout, sign it, and we send it to the CPC Bangalore. But right now, due to the implementation of other OTPs, the verification has been digitalized. And what are the different ways in which we can verify, electronically verify the ITR? It is one, using the OTP on the mobile number registered with Aadhaar. As of now, it is working. So after filing the return, say if my mobile number is registered with Aadhaar, it is not linking, it is registering. So we have to go to the ICAI center for registering it. So we can, if we have our mobile number is registered, then the OTP will be sent to the registered mobile number with 10 minutes validity. So we can verify it. And then another method is, say we have to use EVC, electronic verification code. Say EVC can be generated through net banking or through the validated bank account or through a demat account. And if I already have an EVC, then I can use that EVC. Say if we have a bank account, we know that we have to anyway validate a bank account, because in order to, only if it is validated, we can ask it for refund and the refund will be credited to our bank account. So since we have validated it, and we can enable it for EVC, but it will take little time. So if our bank account is validated and EVC enabled, then the mobile number which is registered with the bank account, the OTP will be sent to that particular bank account's registered mobile number, and we can submit that OTP and we can e-verify it. Once it is e-verified, the entire return filing process is completed, and so then we need not take a printout and send it to CPC Bangalore, but we can just print out the acknowledgement and we can keep it in our safe custody for future reference. Now we will discuss some of the provisions related to house property and salary, which generally appears in the income tax portal. Say income from house property, actually section 22 to 27 of Income Tax Act deals with income from house property. Say section 22, which is a charging section, the annual value of a building or land appurtenant thereto is taxed as income from house property. Say it never says that only residential houses are treated as house property. It can be buildings, warehouses, etc. Any building, its annual value is charged as income from house property. So for salaried employees or individuals who are into the employment, say generally for them there will be only residential buildings. But say those individuals who are having business income, say there are certain cases where the individuals, they construct a building, say they let it out, they generally let it out. Say it need not be a residential house, it can be say commercial buildings or say small godowns, etc. And in such cases we have to assess whether the income is taxable under house property or PGBP. So suppose if the entity is say a partnership firm or something, then if their preliminary business or if their main business or if the object clause defines the business as letting out, then those income will be charged as business income. But if it is not specifically stating that their sole income is from this letting out business, then even if it is a commercial building, if it is let out, then the income will be charged only under the head house property and not PGBP. So the buildings which are let out, and if it is taxable under the head house property, then there are actually three categories. And if we go to the income tax website for filing the returns, and if we are going to enter details in the house property column, then they will ask us these three questions. What is the type of house property? So it can be self-occupied, or it can be let out, or it can be deemed to be let out. So let out is the buildings which is we let out for a monthly rental. Then self-occupied is the property in which we live and whose NAV will be 0. And deemed to be let out, say there are certain buildings, say, which might be self-occupied, but which can be deemed to be let out. Only maximum 2 houses can be treated as self-occupied, and if a third house is being self-occupied, it will be treated as deemed to be let out. Now, how we compute income under the head house property? Say, as per income tax act provision, the annual value of house property is being taxed. So therefore, the GAV is the amount from which we started to calculate our income under the head house property. Say GAV is gross annual value. It is annual value which is taxed, and there is a comparison of municipal value, fair rent, standard rent, and the actual rent, on whose comparison we arrive at the GAV. But in the income tax portal, even if we give an option of let out house, say they never ask us the municipal value or fair rent. So it is on the department, say, to ensure whether the actual rent is in par with the municipal value or fair rent, etc. From the assessee's perspective or from the client's perspective, so they ask us the gross rent received or receivable. So when filing the return, we need not collect the expected rent, municipal value, fair rent details. We will generally assume that we are lending it on the normal market rate, and we will be giving the gross rent received less municipal tax paid during the year. On a payment basis, we can claim deduction. So GAV less, or the gross rent receivable less municipal tax paid, we will get the NAV. And for self-occupied, the NAV is nil, whereas let out or deemed to be let out, the NAV will be more than 0. It will be a positive value because they have actually received rent. Now, from NAV, 2 deductions are permitted. One is a standard deduction at the rate of 30% of NAV. So it is a flat deduction and no condition is to be satisfied. We can claim this deduction. Like standard deduction in salary at the rate 50,000, there is a standard deduction rate 30% in income from house property also. Then apart from standard deduction, the only deduction which is possible is interest on borrowed capital. Generally, many other deductions or many other expenses might have been incurred with the self-occupied property. So we might have painted it, we might have made some repairs, or we might have some personal expenses, or say certain decorations or certain fittings purchased. But those expenses cannot bring us any tax benefit. The only tax benefit is interest on borrowed capital. Interest on borrowed capital and standard deduction. So interest on borrowed capital, it can be for purchase or acquisition or construction or repair of the house property. Then arrear rent or unrealized rent. Okay, say suppose if we are receiving certain arrear rent or unrealized rent, so those rent received is taxable as income of house property on the year of receipt, and the total receipts, and we are able to deduct 30%, and the balance, that is the 70%, will be added and it will be taxable as income from house property. So a flat deduction of 30% on the amount received will be available for us. Now, how much is the maximum interest on borrowed capital which we can claim as deduction? Say many of the salaried employees, say maybe on their 30s or 35s or 40s, so they will be constructing a new house or they will be buying a new house, and obviously say they might have financed it using on a mix of their own capital as well as borrowed capital. Now, for the borrowed capital, say the bank might be from say some financial institutions or banking companies, and they will be charging say 7% or 8% or 10% interest, bank interest. Now, those interest expense we can claim as deduction under the head income from house property. So, self-occupied house NAV will be 0, and this interest on borrowed capital is expense which has to be claimed, and hence our income from house property will be negative. So there will be loss from house property, and those loss can be set off against any head. So we can set off it against salary. We can set off it against any other head, but very interestingly, say business or capital losses cannot be set off against salary. So we have to set off house property loss against salary income. Now, the property can be either self-occupied or let out, but in the case of say salaried employees, in many cases, it may be self-occupied. In case of self-occupied, what is the or how much is the maximum allowable limit? So the maximum allowable limit is 30,000 or 2 lakhs. 30,000 or 2 lakhs. So if the loan is taken on or after 1/4/1999, so there are two cases. So if the loan is taken on or after 1/4/1999 and loan is taken before 1/4/1999. So if the loan is taken on or after 1/4/1999 and the purpose is for construction or purchase, if it is for construction or purchase, then the maximum limit is 2 lakh. And if it is for the repairs of house property, it is 30,000. So at present, if a person is taking a fresh loan for construction of house, then maximum deduction is 2 lakh. But if a person is taking a loan for repairs of house property, then the maximum interest which he can claim is 30,000. And if it is before 1/4/1999, say still generally a housing loan can be from 15 years to 20 years or 25 years. So those who have taken 1998 for 25 years, still they will be paying EMIs on those loans. So for them, say if the loan is taken before or the loan is taken on or before 1st April, and for construction or repair, whatever be, the maximum benefit is 30,000 rupees. Maximum interest on borrowed capital is 30,000 rupees. And now if it is a let out house property, then those issues are not there. If it is let out, then if it is for construction or purchase or repairs, whatever be, the actual interest can be claimed as deduction. So there will be, if it is let out, obviously there will be NAV will be positive, and from NAV we can claim 30% standard deduction and the actual interest liability. The actual interest liability, there is no upper limit capping. There is no upper limit capping. And in case of house property income and borrowed capital, there are a lot of confusions or issues which pop up, and very important points related to those are, in case of self-occupied property, the upper limit for deduction of interest paid on housing loan is 2 lakh. However, this deduction is not available for person opting for new tax regime. So as I said earlier, in case of 115 BAC, if we opt 115 BAC, the new tax regime, then he has to forego the benefit of section 24B. That is, in case of self-occupied house property, he cannot deduct interest expense. But if it is let out, then he is able to set off, or he is able to claim deduction. But if it is loss from house property, he cannot set off it under new tax regime. So self-occupied property, the interest expense cannot be claimed in the new tax regime. And deduction under 24B is allowed on accrual basis and not on payment basis. say 24B is interest on borrowed capital on self-occupied property. So it is allowed on accrual basis and not payment basis. So even if I have not paid the interest, the actual interest due, I can claim as expense or I can claim as deduction. So once I claimed it as deduction under accrual basis, then I cannot again claim it as deduction on payment basis. So it is claimed on accrual basis. But however, very contradictory point is that the principal portion on borrowed capital, which we claim under 80C as Chapter 6 reduction, it is allowed on payment basis. So the interest in 24B is allowed on accrual basis and the principal portion under 80C is allowed on payment basis only. Now there is a concept of composite rent. There is a concept of composite rent. So composite rent is letting out of building and other assets. Say for example, generally this type of renting is we will see in say technoparks or info parks or other startup missions, say where say we can say a cabin or a workstation. We call it as a workstation. A workstation is given to say one employees, and the rent being charged is per chair and not on a building, not per square feet. It is for a chair, say 2,500 rupees or 5,000 rupees per month, and they will be availing benefits of say Wi-Fi or reception area, car parking area, say washrooms or cafeteria. So all those facilities, common facilities will be available for them, and the rate offered is per chair. And if say there is 5 staffs working in a company and per chair rate is 5,000, the total rent will be 25,000. So they need not spend a fixed amount, say on fluctuation basis, depending upon the number of chairs, say the rent will be given. So in such cases, it is a composite rent. Say the space is let out, but the space is only incidental to the workstation let out. In such cases, and if the two lettings are inseparable, say the workstation and the facilities, the building and the facilities are inseparable. Even if the price can be separate, but the general trend is that they let out these two always together. In such cases, it is a composite rent, and in case of composite rent, entire rent is taxable as either PGBP income or income from other source, and it is not taxed under house property. The use of building is only incidental to the letting out of workstations, so therefore it is not income from house property. It is income from other source or income from business or profession. So suppose if it is separable, then the building rent is taxed under income from house property, and the other assets or fittings rent will be taxed under PGBP or IFOS. If it is inseparable, entire amount is taxed as IFOS or PGBP, and it is not under the head income from house property. Then many times say many employees discuss about the joint loan. Okay, say the first and foremost point, I think somebody asked a doubt in the comment section. Many of my clients are facing refund issues. How to communicate this with the department? Is filing grievance will be a solution for this? Actually, during last year, grievance filing, one point is, say many of the returns has been stuck. Say the processing, those who filed on September month, say they were not able to get the refund, and those who filed on December, so they received their refund on January itself. Within 2 weeks, they received the refund. But those who filed on September, they were still not able to receive the refund. In such cases, say once I called to CPC Bangalore, so in such cases, say they told that say there are some issues from their backend and they are trying to resolve it. So you need not do anything. It will be automatically processed. But the thing which I did was, say I filed a revised return. Okay, so the time limit for revised return has not lapsed. So thereby with the same income, I filed a revised return on January, and for the revised return, say within a month, I received the refund back. So grievance filing, so they will give a mail which says that they have accepted the grievance, they will work on it. It's a standard sentence. We need not rely on it. And other than that, so they might come up with a solution, or they might come up with a solution that so they are working on it, or they will process it at the end, at the earliest. The solution is that either we can call the CPC Bangalore, but other than that, if it is too much delay and the latest returns are being processed, then a tricky way is to file a revised return with the same amount, and so they might be they are processing it as batch wise. Okay, they are processing it as batch wise. So if one batch there are some errors, so they will keep it there, and they will resolve the issues, and the subsequent batches the correction is done very quickly. Okay, one more doubt. In the case of self-occupied property, if the assessee being individuals, husband and wife, jointly holding two properties other than the one they state, can they take each property as additional one property for claiming exemption? Say, the most important point is that the assessee should be the owner. Assessee should be the owner of the property. If assessee is the owner of the property, then they can claim it as let out property. So that's actually a very good question. Jointly holding two properties other than the one they state, can they take each property as additional one property for claiming exemption? Okay, let me think upon it. So on a quick answer, I'm not able to come up with. Let me think on it. I will try to answer it at the end of the session. Let me think on it. I was discussing on the point of joint loan. The first and foremost point for claiming a property under the head income from house property is that the assessee should be the owner of the property. And in many a case, say if the ownership is joint ownership, then both of them, if they are joint owners, then both of them are eligible to claim they can claim it as NAV, and in such cases the total income from house property, the NAV will be 0, and each one of them can claim interest on borrowed capital up to 2 lakh. Each one of them can claim interest up to 2 lakh. But if suppose the loan should also be joint account. In order to claim income tax benefit on interest on housing loan, two basic conditions has to be claimed. Then you should be the joint owner of the property and you should be the joint borrower of the loan. So suppose you are only the joint borrower, and if you are not the joint owners, then you cannot claim deduction. You cannot claim deduction. Say you should be the joint owner plus you should be the joint borrower. Then only you can claim the interest on the borrowed capital. So each co-owner can claim interest on borrowed capital up to 2 lakhs on self-occupied property. So each one of them can claim 2 lakhs individually, 2 lakhs on the interest portion. And ATC principal repayment is eligible under ATC, say which is allowed on payment basis. So those, say, we can individually match upon the payments from each person, and it is on the basis of who paid the principal portion, the deduction is actually eligible to each of the two joint owners. Now, apart from section 24B, in case of self-occupied house, even if we claim, say, 2 lakh under income from house property as interest on borrowed capital, again there is a section under chapter 6A, which is 80EEA. 80EEA is a deduction available only for individuals towards interest payment made on loan taken for acquisition of residential house property for the first time. So this is not for construction or repairs. So loan should be taken for purchase, or loan should be taken for acquiring residential house property, and that is the first house property, and the loan should be sanctioned between 1st April 2019 and 31st March 2022. The loan should be sanctioned between 1st April 2019 and 31st March 2022. And then in such cases, say, deduction is allowed on the interest payment, and the maximum deduction is 1.5 lakhs. So the interest portion. So we can claim in 24B, and if there is any excess amount, say up to 2 lakhs only, we can claim under 24B. If there is any excess amount, that we can claim under 80EEA. But the loan should be sanctioned between 1st April 2019 and 31st March 2022. Okay. So in case of income from house property, only few figures has to be filled in the income tax web portal, say, which is related to whether it is self-occupied, let out, or deemed to be let out, and then what is the gross rental received, then what is the municipal taxes paid, and then what is the interest on borrowed capital. So interest on borrowed capital for let out, we can claim without any limit, and whereas in case of self-occupied, we can claim 30,000 or 2 lakhs at a maximum. And if it is not eligible for 80EEA, and if the interest is more than 2 lakh, then in such cases, excess interest can be carried forward to 8 subsequent years. If the interest on borrowed capital is more than 2 lakhs, the loss will be in loss from house property will be maximum 2 lakh. And if the excess interest or the excess loss can be carried forward to the subsequent financial years up to 8 years. Once it is carried forward, it can be set off only against house property income and not against any other head. So 80EEA, this deduction is under chapter 6A, which deals with acquisition of residential house, which is sanctioned. Loan should be sanctioned between 2019 and 2022. Now, apart from 80EEA, and there are other chapter 6A deductions, available for individual or individual taxpayers. So there is very little room for the individuals for tax savings or tax planning, and which is very limited under chapter 6A. So the maximum possible tax savings schemes or deductions permitted are say 1.5 lakhs in ATC, and there are certain other deductions also, but very little room, and we have to emphasis on the maximum savings under the available bracket. Say, as I said, many youngsters whose ATC are unutilized, ATC are we can see ATC is unutilized. So they have to we have to educate them to claim or to invest in tax saving schemes or tax saving possibilities. We have to discuss about them. Now, what are the other Chapter 6A deductions possible for individuals? That is ATC. In Chapter 6A deductions, ATC is the most important section, which deals with life insurance premium, provident fund payment, subscriptions to equity shares, then tuition fees, national saving certificates, housing loan principal repayment, and there are certain various items. So we will come to these various items on a later time. Then 80CCC deals with the annuity plan of LIC or other insurers towards pension schemes, and 80CCD1 deals with the pension scheme of central government, say national pension scheme of the central government. So 80C plus 80CCC plus 80CCD1 in total we can claim maximum 1.5 lakhs. 1.5 lakhs is the maximum possibility under 80CC, 80C plus 80CCC plus 80CCD1. And generally, say certain employees, say government employees, say they generally completely utilize this 1.5 lakhs, and again they will have 80CCD1B. 80CCD1B deduction towards payment made to pension scheme of central government, excluding deduction under 80CCD1. Say 80CCD1 and 80CCD1B are the same, say the same in NPS contribution. But if there is any excess amount, even after claiming under 80CCD1, they can claim under 80CCD1B up to a maximum of 50,000. So very high possibility for salaried employees to claim both 1.5 lakhs in ADCC or C or CCC or CCD1 plus 50,000 in 80CCD1B in totaling to 2 lakh. So total Chapter 6A deductions from these 4 sections can be claimed up to a maximum of 2 lakhs. Then 80CCD2, actually 80CCD2, it is depending upon the employer contribution. So the deduction towards contribution made by employer to pension scheme. So only if the employer is contributing to NPS, National Pension Scheme, then only say that as a client can claim under 80CCD2, it will be added in the gross total income and it can be claimed as 80CCD2 deduction, say maximum of 14% of salary if it is a central government, and if it is state government or other PSUs, maximum of 10%. So there assessee cannot plan himself to claim deduction under 80CCD2, it depends upon the employer. But whereas the 80CCD1 or 80CCD1B, it is a scheme of some national pension scheme, it can be claimed by any employee. So apart from 80C investments, 80D deals with the medical insurance premium. Medical insurance premium, preventive health checkup, and contribution to central government health schemes and preventive health checkup. So even though this is not a return generating investment, it is actually an outflow preventing planning. Say when we pay to a medical insurance premium, say if no hospital emergency happened in a year, then we will not refund, we will not get the refund of the medical insurance premium. So there is a general tendency on many say salaried employees to stick on to return generating investments only, but money saved is money earned. So to restrict the outflow of money is also an investment, is also a return generating method. So if any unexpected hospital cases come, so the money can be the outflow of money is very high, So whatever we have saved in the last 1 or 2 years can say wash out within 2 or 3 days in a hospital ICU. So preventive health insurance, for many of the corporate companies say they give their own health insurance policies covering themselves as well as their spouse, but in many corporates they never add the parents to the insurance plans. So if we have to advise the clients that if there is no health insurance coverage for their family or their for parents or spouses or children, then they have to take an insurance policy, health insurance policy, and it is a tax saving scheme also. Say for self, spouse, dependent children, up to 25,000 can be claimed under 80D, and again for parents, again further 25,000 rupees deduction is possible. So in totaling to 50,000. If anybody is senior citizen, the limit of 25,000 can be enhanced to 50,000. So 25,000 or 50,000 plus 25,000 or 50,000 to a maximum of 1 lakh can be claimed under 80D. And very interestingly, say preventive health checkup, even if it is paid in cash, preventive health checkup, even if it is paid in cash, say 5,000 rupees can be easily claimed as deduction. So if there is any purchase of medicines or other checkups, then whatever amount has been spent on it, say we can claim this 5,000. And even if it might not be reflected in the form 16, but still we can claim extra deductions in chapter 6A if we want to while filing the returns. So 80D 5,000, but this 5,000 is included in the 25,000 or 50,000 above. So for parents 25,000 or 50,000. And if suppose if there is no health insurance premium for parents who are senior citizens, generally when for the people with 60 years or more, the insurance premiums are generally high. Say for one person, it can go up to 19,000 to 25,000 rupees. So since it is a huge outflow in a month, generally some tends not to claim this medical insurance premium. They will not take this insurance premium. In such cases, if there is any hospital cases and if there is any medical expenditure incurred towards the treatment of parents and who are senior citizens and against whom there is no insurance premium, then the medical expenditure, whatever medical expenditure has been spent, it can be claimed as deduction under 80D up to maximum of 50,000. But suppose if we have medical insurance premium, then it will be the expenses will be reimbursed to us. In such a case, medical expenditure cannot be claimed as deduction. So to summarize, in 80D, the medical insurance premium, if there is premium paid, then we can claim it as expense. We can claim it as deduction. If there is no premium, then medical expenditure can be claimed as deduction, but that is only for senior citizens. That is only for senior citizens and not for people with less than 60 years of age. Now 80E again, interestingly, 80E is deduction towards interest payment made on loan for higher education of self or relative. 80E is interest on loan for higher education. Interest on loan taken for higher education. So if the higher education loan is taken and it is repaid, then the interest portion can be claimed as deduction under 80E. Then 80GG, as I discussed earlier, if we are not in receipt of HRA, and still we have rental expenses, then we can claim the rent paid under 80GG. So in order to claim 80GG, we have to file Form 10BA also, giving the details of the landlord address and the rental details. So if HRA is not available or HRA is not received, then only we can claim 80GG. And the maximum deduction under 80GG is least of the following: 1, rent paid minus 10% of salary, total rent paid minus 10% of total income, then 5,000 per month, then 25% of total income. So out of these three, what is the least amount? The least amount can be claimed as 80GG. So the statutory benefit is given is 5,000 into 12. That is maximum 60,000 is the amount which can be claimed as deduction under 80GG. Now 80TTA, I have not written 80TTB. So there are two sections, 80TTA and 80TTB, which is actually income based deduction, So this is not deduction which is claimed on investment, but this is a deduction which is available on the income, and the income is interest on deposits. So suppose if I am a person with, I am not a senior citizen, less than 60 years of age. In such cases, less than 60 years of age, they can claim deduction up to 10,000 rupees, and that too only on savings bank interest. So if I am not a senior citizen, then against my savings bank interest, I can claim 10,000 rupees. Say I have never seen, even though the savings bank account gives interest on a quarterly basis, but the average savings bank account balance will be very low, and the total interest will be very negligible for generally many salaried employees. So in such cases, say they will not tend to, and since it is not reflected in 26 AS also, they never tended to show it in the ITR also. But if we are showing the interest income, interest on savings account, then against such interest income, say up to 10,000 deduction can be claimed. But generally the salaried employees who are not senior citizens, they will have fixed deposit, and fixed deposit interest will be there. But against fixed deposit or recurring deposit interest income, we cannot claim any deduction. There is no deductions permitted against fixed deposit or recurring deposit interest. But suppose if I am a senior citizen, and the senior citizen has interest income, it can be interest on savings or interest on fixed deposit or interest on recurring deposits. Against such interest income, a deduction of 50,000 is permitted. There is no declaration to be submitted. It is a deduction on the income. So from the income, 50,000 deduction is possible, and the balance fixed deposit interest income is only taxable. But this benefit is available only for senior citizens. And if I am not a senior citizen, then against fixed deposit or recurring deposit interest, no deduction is possible. Now, what are the other ATC eligible investments? So as I said, in ATC is the bigger room for claiming deductions with tax saving investments. Actually, we have to stress on not only the tax savings aspect, we have to emphasize on the income generating aspect also. All these tax savings investments will generate interest income or will generate returns, say varying from say 7% to 15 or 20% interest income. So if the spend and save mechanism is actually worse, and save and spend mechanism should be implemented. It should be implemented individually wise, and in such cases they have to invest in tax saving investments. What are the tax saving investments which are available in front of us under ATC? One is tax saver fixed deposits with a lock-in period of 5 years, which can be opened by resident individuals. Interest income is taxable on maturity. So the easiest way for claiming Chapter 6 reduction under ATC, if we have unexhausted balance in ATC, then we can open a fixed deposit in scheduled bank. We can open a fixed deposit in scheduled bank, say with a lock-in period of 5 years. So it has a lock-in period of 5 years, the interest will be accumulated, and on maturity, the interest income will be taxable, and it has a lock-in period of 5 years. Then again, investment in public provident fund opened by resident individuals with a lock-in period of 15 years, extendable to further 5 years. Partial withdrawal after 7 years is possible. Interest is exempted. So if I am a salaried employee, there will be statutory or recognized provident fund, and even if there is a recognized provident fund, I can open a public provident fund account. For self-employed assessees also, so they can also say even chartered accountants, say who are self-employed, so they can also open a public provident fund account. But the point is that the public provident fund is actually planned to give a retirement benefit. So that's why there is a higher lock-in period of 15 years and we can extend it by say 5 years. But partial withdrawal is possible after 7 years in case of emergency. The interest on public provident fund, there will be only our contribution and the interest generated on that contribution is exempted. Then investment in employee provident fund available to salaried employee. Entire amount is exempted if withdrawn after continuous service of 5 years. Say recognized provident fund, generally with employees with more than 50,000, 15,000 basic salary, say they participate in the provident fund and the employer also contribute an employer contribution to provident fund. Employee also contribute a share to the provident fund and the fund balance will generate interest income also. And whatever amount interest is accumulated in recognized provident fund, it is exempted. And it is if after continuous service of 5 years, if we withdraw the figure amount from this recognized provident fund, that is exempted. Or if we close the account after continuous service of 5 years, then it is exempted. But if we cancel the account and if we take the amount within 5 years of continuous service, then TDS will be deducted on premature withdrawal from the provident fund. If the amount is more than 50,000, TDS will be deducted under 194A at so not 194A, sorry, 192A at the rate of 10%. Then investment in national pension system opened by every Indian citizen, partial withdrawal after 15 years. Say NPS account, there is tier 1 and tier 2 NPS accounts. Say we can open it, say even employees as well as self-employed persons can open this NPS account. And there is a high lock-in period because it is intended as a retirement benefit. So we can withdraw, partial withdrawal is possible after 15 years. So there is a high lock-in period for this provident fund, public provident fund, recognized provident fund, and this national pension scheme. Then investment in ULIP, unit linked insurance plan, purchased for self, spouse and children, which is a mix of insurance and investment in stock market. Say if we purchase ULIP units, then there will be insurance coverages as well as there will be return which by way of investment in stock market. Then investment in Suganya Samruddhi Yojana by parents or guardians in the name of a girl child, partial withdrawal when the child attains 18 years of age. So if a parent has a girl child, then they can contribute to Suganya Samruddhi Yojana, and partial withdrawal is possible once the child attains 18 years of age, and complete withdrawal is possible after 21 years. And the entire maturity amount, the interest as well as the maturity amount is exempted. And that is also a long-term investment plan, since it is as a lock-in period of say 18 years of age. Then life insurance premium paid for self, spouse, children up to 10% of sum assured. Generally, life insurance premiums or policies will have a time period of say 10 years or 15 years or 20 years or more than 20 years. So in such cases, say we have to contribute for continuously for 15 years or 20 years, and we will have a maturity amount after 20 years. So there can be endowment plans, there can be risk plans also. So both are eligible for ATC deduction, but whereas for risk plans, there won't be any returns. But whereas for endowment plans, there will be, we will receive the maturity amount back after the maturity period. So life insurance premium up to 10% of the sum assured can be claimed as deduction if the loan is taken on or after. So if the pre-insurance is taken on or after 1/4/2012. Then repayment of housing loan, principal amount, then stamp duty charges, registration fees and transfer expenses. So as we have discussed, interest on borrowed capital can be claimed under 24B and the principal portion can be claimed as deduction under 80C on actual payment basis. Then payment of two children's tuition fees for full-time course in India. So very important, it is available only for courses in India to any school, college, universities or educational institution. So two children's tuition fees can be claimed as deduction. Then national savings certificate purchased from post office with a lock-in period of 5 years. Again, there is a lock-in period of 5 years for national savings certificate. It can be purchased from post office. Then equity linked savings scheme, that is tax saver mutual funds with a lock-in period of 3 years. So out of all these 80C eligible investments, the minimum lock-in period is for equity linked savings schemes, which is for 3 years, and rest others vary from 5 years to 15 years to 18 years, etc. So equity linked savings scheme is ELSS mutual funds. So if we go to the asset management company's website, we can see which are the ELSS schemes and we can invest in SIPs. So which are redeemable, which has a lock-in period of 3 years and we can claim deduction under 80C. And once on maturity, when we sell the units, then they are equity oriented fund. Then in such cases, there will be capital gain at the time of redemption. So if we go to the new income tax portal, say while filing the income from salary details, say they will ask, as I said, it is an yes or no questionnaire. So they will ask us, say, are you eligible to claim exemption in respect of leave travel concession or allowances under section 1014? So we have to give yes or no. Are you eligible to claim exemption in respect of special compensatory allowances, children education allowances, host allowances, etc. as per section 1014(2). So there are two types of allowances. Then are you eligible to claim exemption in respect of HRA? So we have to give yes or no. Then again, for a salaried employee, they can claim deduction under chapter 6A, under 80C, all those investments are there. And again, apart from that, there are other exemptions in income from salary, so which is related to leave travel concession, remuneration, but these are generally once in a lifetime expense deductions or rare cases, so death cum retirement gratuity, then received on voluntary retirement, then compensation, voluntary retirement, VRS compensations, then perquisites received outside India, earned leave encashment on retirement, commuted pension, then non-monetary tax on non-monetary perquisites. So these types of exemptions are once in a lifetime exemptions, so which we generally do not come across every year. But if there is any exemptions with respect to this amount, we have to enter the values in the corresponding field. So the income from salary, the structure is gross salary less exempt allowances, then net salary, deductions under section 60, and we will get the income from the head salary. So this is an extract from the new income tax portal. So we have to, maybe the figures will be automatically fetched from the form 16 as well as 26A, form 16. And if there is any change, then we can manually correct it. They will show a dialog box saying that, say that there is a mismatch, but still we will be able to save it and we can proceed. There is no issues. And in gross salary column, we have to give a split up of the salary, the perquisites, the profit in lieu of salary. So this will in total gives us the gross salary. And if there is any exempt allowances, say the generally a salary structure has salary, then exempt allowances or taxable allowances and other perquisites. So the value of perquisites we have to give in point number B. And if there is any allowances and exemptions, then we have to fill in the exempt allowance column. Now, with respect to salary income, say the exemptions are generally given in section 10, and section 10 exemptions is with respect to one HRA. We have already discussed 80GG with respect to rent, and if there is HRA, then he is able to claim deduction. General, as we have discussed relating to Form 12BB, Form 12BB, which is a form which is to be given by employee to employer declaring their investments. In Form 12BB, the employee has to give details relating to the HRA. He has to upload the rent receipts or the rent agreements, the name of the landlord if the value is more than 1 lakh. So such details has to be uploaded in the employer's website, and the responsibility casted on employer is being fulfilled. So the employer will check it and they will approve, and they, while preparing Form 16 itself, they will give exemption to HRF, to house rent allowances. So in most of the employees, their salary package will have HRA as their component. Then there are two different types of allowances, 1014.1 and 1014.2. So 1014.1 is prescribed allowances or benefits specifically granted to meet expenses only necessary and exclusively and to the extent actually incurred in performance of duties of office or employment. So 1014.1 deals with allowances which are incurred during the time of performance of their duties, and it is actually exclusively incurred for the purpose of for employment. In such cases, in 1014, the allowances, the exemption will be the actual amount spent. Okay, it will be limited to the actual amount spent. Say amount received or amount spent, whichever is lower, will be the exemption. Generally, how much amount is spent will be declared by the assessee itself. So what this employees does is that, say whatever amount received, they will declare it as the amount spent, and the entire amount will be claimed as deduction itself. But what Act specifically says is amount received or amount spent, whichever is lower, will be the deduction. And 1014.2 is dealing with the allowances or benefits granted to meet the personal expenses in performance of duties of employment or to compensate increased cost of living. Say 1014.2 deals with the allowances which are incurred for personal purposes. Say hilly area allowances, border area allowances, or modified field area allowances. So such different types of allowances are there. In 1014.2, the exemption, not deduction, sorry, exemption, the exemption will be restricted to irrespective of whatever amount is spent. Irrespective of whatever amount is spent, the exemption will be limited to fixed amount, say 200 per month or 300 per month or 1000 per month. So fixed amount will be claimed as exemption, and the balance amount will be taxable. The balance amount will be taxable. Now, what are the allowances which are mentioned in section 1014? Any allowances granted to meet the cost of travel on tour on transfer, allowances granted for the period of journey in connection with transfer to meet the ordinarily daily charges incurred on account of absence from normal place of duty, allowance granted to meet the expenditure on conveyance in performance of duties of an office or employment, any allowances meted to meet the expenditure incurred on helper, where such a helper is engaged for the performance of duties, allowance granted for encouraging academic research and training pursuits, allowance granted to meet the expenditure on purchase or maintenance of uniform for wear during the performance of duties, etc. So generally, traveling expenses, conveyance, traveling allowance or conveyance allowance, helper allowance, research allowance, and uniform allowance. These are the specific allowances which is mentioned in 1014. So these allowances, whatever is actually spent is exempt. Whatever is actually spent is exempt, and the balance will be taxable. As we have discussed earlier, in case of salary, say gross out of gross salary, there are 3 deductions possible under section 16. So one is a standard deduction up to 50,000, flat 50,000. So without any restrictions or conditions, this 50,000 can be claimed as deduction. Entertainment allowance, but this deduction is eligible only for government employees and a maximum of 5,000 and a maximum of 5,000 rupees. Then professional tax actually paid. Professional tax paid generally 2,400 or 2,500 is the professional tax which is being deducted and paid to the state government. So these 3 deductions are the only deductions possible in income from salary. Other than that, our personal travel expenses or holiday travel expenditures, all those are not allowed as deduction. And we have already discussed the comparison of old tax regime versus new tax regime under section 115 BAC. And if we are opting 115 BAC, deduction under section 16 will not be eligible. So we cannot claim standard deduction, entertainment allowance and professional tax. So we have to forego those benefits and we have to compute total income in 115 BAC. So gross salary less deduction under section 16 will give us the income chargeable under the head salaries. There are exempted allowances also, but generally the exempted allowances are for high court judges or Supreme Court judge and other certain government employees only. Other than that, say normal say working employees or private companies employees, say they will not have any exempt allowances. Say other allowances by whatever name called, apart from these allowances, it will be fully taxable. It will be fully taxable. So there can be in a salary package, there can be other allowances or other allowances. So which means those are taxable allowances and there is no specific tax exemption for those allowances. Now coming to the salary provisions, say section 15 to 17, section 15 to 70, there are 3 sections in Income Tax Act which deals with salary. But in order to claim the benefits from salary, we have to refer section 10, which discuss the exemptions, and chapter 6A deductions from 80C to 80U. Now section 15, 16, 17 deals with the taxation of salary, and section 15 says any salary due from an employer or former employer to an assessee in the previous year, whether paid or not. Say salary is taxed under due or receipt basis, whichever is earlier. Salary is taxed on due or receipt basis, whichever is earlier. So generally, even if the salary is not received, if it is due, then we have to take it as the income from salary. Say suppose if we received salary in advance, then on receipt basis, we have to claim it as gross salary. We have to claim it under Income Tax Act. But say when we file the returns of say government employees, generally our financial year is April to March. But for government employees, generally if we see their form 16 or 26 AS, then we will see they follow March to February as their financial year. Why? Because say the March salary, the treasury in the TDS, all the deductions happens in February, and the March month salary generally becomes due and received only on April. And if we see the 26 days itself, in April month, 2 salaries will be credited, one of March, another one of April. So generally for government employees, say while filing the returns also, March to February cycle is being followed in all places. So due or receipt basis, whichever is earlier, is the taxation of salary. So if any advance salary is received, we have to tax it on receipt basis. Then salary received from employer or former employer or more than one employer, all the salaries will be taxable under the income from salary itself. Then arrear salary, again received, whatever arrear salary is received, we will tax it on the year of receipt. And we have discussed, say, form 10E has to be filed if arrear is being received in order to claim benefit under section 89. Arrear relief, in order to claim the arrear relief, we have to file form 10E, which gives us benefit under section 89. And the salary, commission or remuneration received by a partner from a partnership firm. So we know that every partnership firm, there will be interest on capital as well as partner's remuneration or partner's salary. But those partner salary and interest, so all those incomes which is received by partner in a firm, so it is not taxable under the head income from salary. It is taxable under the head income from business or profession. So the income of the firm is taxed under the head business or profession, and so is the interest income as well as remuneration received by the partner. It is also taxed under. It is also taxed under income from business and not under the head income from salary. Now, what is the meaning of salary? So salary means wages, pension. Say if any retired employees are there, so they are receiving pension, then those pensions are also taxable under the head income from salary itself. Say many times in case of government employees, say they receive their salary through treasury account only. Nowadays it is through online mode, and salary will be credited to the treasury account. And generally the method they follow is that, say, they fill up the details and form 16 will be issued to them. But once they retire, so they will not be filling up this form 16 details, and hence the retired employees, they will not be getting any form 16. And in such cases, what say they will not have any documents with them for claim for which shows their salary incomes. In such cases, we can advise them to contact the treasury, say where the salary is being deposited, and the treasury department or where the salary is being remitted. So they will give them the details of the salary which is being credited on a monthly basis, and using that particular document which is given from the treasury, say we can file their returns. Then any fees, commission, perquisites, profits in lieu of salary, then payment received by employees in respect of leave, travel, earned leave, then annual accretion to the balance of provident fund, aggregate of the sum or transferred balance relating to recognized provident fund to the extent it is chargeable, the contribution made by central government to the account of the employee under pension scheme referred under 80 CCD. So as I said, employer contribution to national pension scheme is added in the gross salary, and this same amount to a maximum of 10% of the salary or 14% of the salary can be claimed as deduction under 80 CCD. Now, so the salary includes basic salary, then allowances as well as perquisites. So we have discussed allowances. There are taxable allowances, there are exempt allowances, but which are only for, say, high court judges and all, or collectors. Then there are certain partly exempted allowances which we have seen in 1014 and 1014.1 and 1014.2. And there are perquisites also. Say many a times, say if some of the employees who are working in banks, say they will be given rent-free accommodation. So the rent-free accommodation, there will be a component in their salary and they will be given accommodation by the company, and the company will be directly paying the rent to the owner, and the assessee is not required to pay any amount as rent, but it is being deducted from his salary. So this rent-free accommodation is actually a benefit which is given by employer to the employee. So these benefits are generally taxed as perquisites. Perquisites can be sometimes non-monetary also. So rent-free accommodation, then the value of concession in the matter of rent respecting any accommodation provided by assessee. So there can be rent-free accommodation as well as concessional accommodation. Say the entire rent need not be paid by the assessee. A part of the rent has to be paid by assessee and the balance will be paid by the employer. So concessional rent. And it can be accommodation, can be furnished accommodation or unfurnished accommodation. Say in case of furnished accommodation, it means say apart from the building, there will be furniture and fixtures like television, radio, refrigerator, household appliances, AC or other equipments or gadgets. So that is also provided to the employee. In such cases, so the cost of the value of perquisite for furnishing is 10% of the cost of the asset. It is 10% of the cost of the asset for furniture and fittings, etc. 10% of the cost of the asset is the value of perquisite. The value of benefit or amenities granted or provided free of cost or at concessional rate to specified employees. Say specified employees means a director or employees who are receiving total salary of more than 50,000. So they are treated as specified employees, 50,000 in a year. So they are treated as specified employees. So there will be many benefits like ESOPs or concessional loan or medical facilities or such other benefits. So those benefits or amenities are also taxed as income from salary. So since they are non-monetary, we have to value them. We have to calculate the value, and those value will be added to the income from salary. So in case of while with respect to chartered accountants for filing the returns, say those values would have been already arrived at while preparing their form 16, and for us if there is any disputes, then we can cross check it, or else we can use those figures itself to file the return. It is not something which we have to calculate on our own. It will be given by the employer itself. Then any sum paid by the employer in respect of any obligation which but for such payment would have been payable by the assessee. Any sum payable by the employer which directly or through a fund to effect an assurance on the life of the assessee or to effect a contract for an annuity. The value of specified sweat equity shares allotted or transferred directly or indirectly by the employer or former employer free of cost or at concessional rate. So when the sweat equity shares or the shares of the company is given to the employees, it is taxed at the fair market value. So the fair market value less the actual price given, the difference will be their benefit, and that benefit is actually taxed. And in case of an eligible startup, it is postponed to say 48 after 48 months, or when we resign from the company, or when we transfer those shares, whichever is earlier, the taxation as well as the TDS deduction is postponed to that later date. Then the aggregate of amount of contribution in recognized provident fund or NPS or superannuation fund in total to the extent more than 7.5 lakhs in a year. So if the employer is contributing to recognize the provident fund, pension scheme as well as superannuation fund, and the total amount in all these three is more than 7.5 lakhs, the excess amount will be the value of perquisite. And on that excess amount, whatever interest or dividend or any other accretions are happening, so all those will be treated as in the perquisite given to the employee, and it will be taxable in the hands of employee. So for an employee, for a salaried employee, the income from salary, so generally the employer will be taking into consider all the benefits which are accruing to them. So as an outsider, we will not be knowing the what benefits which the employee is receiving from the company. So it will be available in the Form 16, what are the salary structure in it. So we can use those Form 16, we can cross check with the 26 AS if there is any other specific deductions or specific income has been received. Then generally house property details can be given to the employee, which will be considered by the employee while computing the total income. But generally, other than house property loss, no other losses will be considered. Then sometimes in the Form 16, the house property related details will not be available. So in such cases, we have to ask the client whether the client has any self-occupied house and whether there is any interest on loan borrowed or whether there is any loan taken for the construction or repair of the houses. And in case of let out, we have to ask them the details, we have to refer the bank statements, and we have to claim the calculate the NAV, etc. And Chapter 6A deductions, say 80C and 80D are the most important sections in which they can claim maximum deductions. In 80C, if we plan accordingly, we can claim a maximum of 2 lakh 80C plus 80 CCD 1B. And in 80D, we can claim say up to 25,000 for self, spouse and children, and for parents, dependent children, and for parents again, so we can claim another 25,000 or 50,000. Then the expenditures, say 80G deals with donation. Say there are high possibility that for central government employees, say 1% of their salary, 1 day salary has been deducted and paid to PMKS. So which will be eligible as deduction under 80G 100% without any restriction. Or there can be situations where the normal employees, say the private companies employees, say they have deposited or they have contributed to Chief Minister's relief fund, or they have paid to PM Care Fund, say which are eligible under 80G 100% deduction without any restriction. So if there is any donations, then we have to collect. We have to mention the PAN of the fund. So it will be available in the website, the PMKS website or the Chief Minister's Relief Fund website. Their PAN will be eligible. It will be available, and we have to fill the details of the PAN and the amount, and we can easily claim the deduction also. And due to lockdown, actually, say during lockdown, the stock market transactions has been increased, say many times. So the volume, the new Zerodha account holders or Upstocks account holders has been increased. So there is a possibility that many employees or many the persons who have filed returns in ITR 1, say they might have started or opened a demat account. Okay, only if we ask them, say we will get those information. So they might have opened their demat account and they might have done some trading. So if there is speculative business or intraday trading, then of course it is a business income, and in such cases, say ITR 3 would be the returns and ITR 1 will not be possible for them. Then if there is again capital gain also, then the ITR form will be changed, and for claiming or for calculating the capital gains or PGVP income, generally say if the leading stockbrokers include Zerodha also, so there is a tax P&L statement which can be downloaded from the demat brokers, the brokers web page or our login page. We can download the tax P&L or the total P&L. So in that P&L, there will be trade-wise profit, the total charges, the total STT paid, the total brokerage, all those details will be available in the tax P&L sheet, and they will bifurcate it as short-term capital gain, long-term capital gain, or short-term capital loss or long-term capital loss. So using those tax P&L, we can compute the capital gain easily. So share the stock-wise sale and purchase details, or sale and purchase details will be available there. So we can get those figures from the tax P&L sheet, and we know that if it is a capital gain, STT cannot be claimed as a deduction. But if it is a speculative transaction, then STT can be claimed as a deduction. Then again, say we have to calculate, if it is a speculative transaction, we have to give the total turnover. The total turnover will be the profit or loss in the absolute figures. The profit or loss in the absolute figures will be the difference between sales and purchase in absolute terms will be the turnover for speculative business, and we can total it from the tax P&L sheet. For capital gain, they will not be asking us a turnover, but they will be asking the total sales, then or the full value of consideration received, then the cost of acquisition. If it is a long term, then 112A will be applicable. There is no indexation. And in short term, 111A will be applicable. Again, there will not be any indexation. But we can deduct brokerage as expenses on transfer, but we cannot claim STT as deduction, and we can arrive at the short-term capital gain or long-term capital gain. And we have to fill those figures in the ITR. But in such cases, the ITR form, we should cross-check whether the correct ITR form has been selected or not. So in ITR 2, individuals and HUF who are not having PGBP income and not eligible to file ITR 1 can claim ITR 2. In ITR 1, as we discussed, only salary income, one house property, IFOS, so they can claim, they can file in ITR 1. So suppose if there is capital gain, then they have to file ITR 2. But if they have any speculative business, then in such cases, there is business income, then they will not be eligible to file ITR 2 also. They will be able, they should file ITR 3. So in such cases, salary incomes, then house property incomes, PGAP income, capital gain income, all those will be filled in the ITR 3 itself. So this is the short summary which I wanted to take on this session. So we have discussed about the new tax regime versus old tax regime, the new income tax portal, what are the tables which are there or which are displayed in the new income tax portal. Then we have touched upon the house property provisions and salary provisions, so which is on and not linked with the way in which we file the income tax returns. So this is what I wanted to share on this seminar. If there is any comments or any doubts,
There are a couple of questions, I think, which you have left it for the end of the session, right, Isidore? So if you want to take that now.
just a minute.
Yeah, sure. Take your time.
But I think few questions are there in the Q&A box. Right?
Yes, he has answered most of them, sir. I think a couple of them he has left it for the end of the session. So just telling him in case he's ready, we can take that.
Okay, one question which is asked for privately was how to file 139 defective, the defective return, say how to correct it in the new income tax portal. The new income tax portal, I have not filed any, I have not any revised any defective return. So only if I could see the site, I could answer it. So that's actually a tough one. Then another one question was actually a interesting question, which say there is the owners are joint owners and they have multiple houses. So whether each one of them can claim one houses. Actually, on last financial year, say the number of self-occupied house properties which we can, the house property which we can claim as self-occupied has been increased to 2. Okay, so only if there is a third house, it will be treated as deemed to be let out. So if there are actually 2 houses for them, then there won't be any debate on that particular point. Say they can claim it as their self-occupied property and there won't be issues. But suppose if there is a third joint property, then say we have to, maybe we have to, I don't know exactly the point. So maybe we have to look at any case laws, whether if there is a third house and the third house is also joined, whether say each one can claim one house as the self-occupied. So then we have to refer any so many case laws. On a strict interpretation, I do not know that particular point. I have to check it. If there is anybody I think this is the last question which I received.
Did you answer the one regarding the uniform allowance?
I could not see that question.
It is there in the chat, common chat. Regarding uniform allowance, what happens if there is no uniform for that company? In that case, whether any formal dress purchase would be enough?
Actually, whatever amount is actually spent is given, is allowed as expense. So whatever amount is spent in respect of uniforms, we can claim as exemption. Okay. So if there is any details regarding any of the uniforms or any regarding their office dresses, they can claim it as whatever spend is claimed can be claimed as expense, can be claimed as exempt.
I think those are the questions till now. So in case there are no further questions, I think we can wind up the session. Joseph, you want to add anything?
Yes.
Or we can close it.
Yeah, we can close if there is no more questions. Diva, you can go ahead with a lot of thanks.
Yes. So a very big thanks to CA Isidore Lukose, a youngster but always very courageous, and he's a true sportsman. I should say that. You know, he's ready to open and talk to people, very senior people, in fact, about income tax, and he's handled the session quite well. Answered the questions, and wherever he was not sure, he's very openly told us that he needs to refer back. So I think that's perfectly fine, Isidore. So if you can leave your email ID for the participants to check, and maybe they can write to you and you can clarify that later, or the members can write to us in our ERNAKULAM ICAI email ID. We will forward it to Isidore and get you the reply for that. So that can also be done. Thank you so much, Isidore, for joining us this evening.
Thank you.
And to the other members, yeah, he has left his email ID in the chat. He's given his number also. So if anybody wants to write to him, please feel free. He's a very, very dear friend of ERNAKULAM branch. A very active participant, in fact. And special thanks to all the members who joined us this evening. And yes, we are on a direct tax drive this month, as Joseph rightly put it at the beginning of our session. We'll be having lots more sessions coming up, and we have a 4-day refresher course, which will start on 6th